Today, are they banking on their own futures or yours? Hi again, it's Martin North from Digital Finance Analytics, one that is post covering finance and property news. Commonwealth Bank was in the news this week, first because of its reported results, and second because of its draconian handling of what's known as Know Your Customer or KYC rules. CBA reported a flat cash profit of $2.6 billion during the third quarter of the 2025 financial year, which was pretty much in line with market expectations and 6% higher than the prior comparative quarter. This is an unaudited quarterly update posted via an ASX announcement, by the way. CBA's share price touched a new high this week at $172.91, and it was last at $169.66. Analysts have been concerned about CBA's extreme valuation and potential for margin pressures to emerge, but UBS's John Story said on Wednesday that CBA's growth in home lending through proprietary channels, this is on website and branches, and that's now 68% of new business, would support retail bank profitability ahead. CBA reported that operating income rose 1%, driven by lending volume growth and higher trading income, largely offset by 2 less days in the quarter. Excluding non-recurring earnings, net interest margin was stable, they said. Operating expenses were up 1%, driven by increased investment in technology and frontline staff, partially offset by 2 less days in the quarter and the benefit of ongoing productivity initiatives. Business loans at CBA surged by 9.1% or $3.7 billion over the 3 months to the end of March compared to the quarter before. And that was 1.3 times the average of the other banks. And the CEO, Matt Comyn, said that he was keen to build on market share gains made on National Australia Bank, which is the nation's top business lender, at least until now. Now, CBA is Australia's largest mortgage lender, writing about 1 in 4 mortgages, and they reported that home loan arrears were at their highest level since 2019, as Matt Comyn acknowledged a challenging quarter for households and businesses. Home loan arrears and personal loan arrears were at 6-year highs. For the quarter ended March 31, 90-day home loan arrears increased to 0.71% over the period, signaling that many mortgage holders are struggling to keep up repayments. The increase is the largest since 2019 and is higher than CBA's historical average of 0.65%. Matt Comyn said households and businesses continue to face cost of living pressures. We've remained focused on proactively engaging with our customers on a range of support options to help those who need it most. Then there's personal loan arrears, were also at their highest in 6 years, with the report claiming the increase was largely in line with seasonal trends, while credit card arrears remained generally stable. CBA says collective and individual provisions for bad debts were slightly higher, and it booked a loan impairment expense of $223 million. Non-performing loans rose from $2.8 billion a year ago to $3 billion at the end of March, while troublesome corporate loans lifted from $3.1 billion a year ago to $3.6 billion at the end of March. In the business book, most stress has been in the commercial property, wholesale trade, and manufacturing sectors. Recent research from ASIC suggests that some of the so-called help provided to the banks simply kicks the can down the road, but builds pressure on customers later. While under the APRA rules, such help means loans are not reported as under duress, which helps to keep the delinquency rates down. The bank maintained a strong capital position with a CET1 level 2 ratio of 11.9% as at 31st of March 25. That's well above APRA's minimum regulatory requirement of 10.25%, but it's down from the 12.2% back in December 2024. Talking more broadly about the Australian economy, Comyn foreshadowed a potential slowdown of the domestic economy. He said a heightened risk to the world economy from geopolitical and macroeconomic uncertainty could affect Australia, though Australia is in a relatively strong position to navigate the challenges, and Australia remains an attractive place to live and work. Government investments in infrastructure and services is helping to support employment and growth, and underlying inflation is moderating, he said. He also praised the Reserve Bank of Australia's experiment in tackling inflation, with every major bank now predicting the RBA to cut rates next week after a fall in inflation in the December quarter. Hold that thought, as you'll see in a minute. I suspect the banks are hoping for a series of rate cuts to try to head off the pressures which many households are under, which until now have been tackled by extending loan terms or going interest only, or even by encouraging people in distress to sell and get out, all of which reduces reported arrears. If in fact rate cuts are slower, as we discussed yesterday, we should expect arrears rates to climb higher. ANZ actually has retracted its forecast that an interest rate cut by the Reserve Bank of Australia next week is a near certainty, arguing instead that policymakers have reason to be cautious about loosening monetary policy. NZ economists said that they have lessened their conviction on the interest rate cut next week, but still assess the risk of the RBA not easing at around 1/3. Progress on China's US tariff talks, muted confidence impact on business and consumer on trade tensions, accelerated first quarter wage growth, and Thursday's resilient labour market data could make the central bank cautious about easing, they said. Now, elsewhere, SQM Research Managing Director Louis Christopher took to social media on Tuesday this week to blast CBA's request for updated personal information as part of its Know Your Customer or KYC requirements, which are overseen by financial intelligence agency Austrac. The founder of the respected property research firm blasted a, quote, disgusting and Orwellian email from CBA demanding he cough up information about his finances, including whether he is holding cash at his home or risk losing his bank accounts. The email warned that if he did not provide the required information, including details relating to your source of wealth within 7 days, we may discontinue, restrict, or limit access to your accounts. What I've just gone through this morning with CBA is disgusting, Mr. Christopher wrote on X in a now viral post. Absolutely despicable Orwellian stuff driven by Austrac. According to Mr. Christopher, he initially thought the email was a scam. When he phoned the bank on a different number, he found it was true. The representative demanded to know, how have I built up my wealth? Why have I made cash withdrawals? If I'm holding cash at home, why? And why did I make certain transactions to third parties? He wrote. They've got rather personal. I was shocked that they would ask me if I'm holding cash at home and why. I regard sharing that information as a security risk. How have I generated my wealth? That's my business, unless they've got more than a slight suspicion I'm doing something illegal, in which case it should require a court order, he said. And he said the email came out of the blue following an earlier email that was sent on April the 5th, which he suspected went into his junk filter. They didn't give me any elaboration on what triggered this, he said, and he noted none of his business accounts were with Commonwealth Bank. Everyone knows I've got a profile. I've got my business, SQM Research. We've been providing property statistics for years, he said. The crazy thing is, I've been a long-term client of CBA. I've been with the bank since 1978. You'd think they might go back and look at the history. It's not an account that's been set up overnight. It's pretty standard transactions. He answered the representative's questions grudgingly, and I expressed to her that I wasn't happy with these questions. He also asked how frequently those questions are going to be asked, and she said, whenever we have a need to update our data banks. The ironic thing is that at the end of this, they wanted to share the information from the phone call with regulatory authorities, as well as with other third-party credit providers. I had to say yes, under duress. Mr. Christopher said, in the end, I was just flabbergasted, and he decided to share his experience online, leading scores of people to also share their own stories of having their accounts frozen. This is not on, he said. Banks should not be allowed to freeze people's accounts unless it's via a court order. It's a human right, and it should not be done on a whim of some manager. And he remains concerned that his accounts may still be frozen because, quote, I was ambiguous on some of the responses. I said the cash is for a rainy day. I'm a bit concerned because other people have given ambiguous answers and have had their accounts frozen. And he added he was not necessarily putting all of the blame on CBA. I suspect it's been driven by Austrac and the KYC rules. The bank's legal counsel probably has some type of legal interpretation of what the bank is required to do, and CBA has taken this position that they have to ask those questions, he said. I get it. They're trying to stop money being transferred to terrorists, money laundering, etc. But the community has got to live as well. We'll never completely stamp out that type of crime. They've got to take a step back. It's going too far. A Commonwealth Bank spokeswoman said, "We are required to manage our customers' accounts in line with the Anti-Money Laundering and Counter-Terrorism Financing Act of 2006, which sets out that all banks operating within Australia are required to collect, verify and maintain customer identification information. In the same way that we need to comply with regulations when a customer first opens an account, we also need to comply with current law regarding the maintenance of their identification information," she said. "Ensuring we have a customer's most up-to-date and correct details also helps us to keep them safe and to protect them from fraud." And by the way, in December, CBA announced a $3 cash withdrawal fee for some accounts, with the ensuing widespread backlash prompting a walkback and an apology. Now, my broader point is this. Banks, of course, are chasing ever higher profits. Perhaps nothing wrong with that if it's done fairly. But when we see perhaps heavy-handed intervention by them on their customers, granted under their interpretation of the government-imposed KYC rules, as well as methods to keep delinquency reporting low, we wonder who they're actually serving. I'm not sure it's their customers. What do you think? I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.